First of all, welcome everybody, to this episode here today. We're excited to have, Richard and Peter with us today. The big thing in NFTs, taxes, something we don't like to think about, but it's that time of the year where we should start thinking about it and strategizing. So, we're glad to have Richard and Peter here today with us. So both of you guys, thank you guys for joining us. And how are we feeling today?
Hey, thanks for the intro. We're feeling great. Definitely very excited to be here, and thank you for having us.
Of course, of course. And I'm sure you guys are getting busy, and I'm sure there's a lot of questions you've heard throughout the last couple of weeks with taxes and NFTs. And it's kind of like a gray area, I'm assuming. There's not, a lot of, precedent for this. So I'm curious to hear you guys' thoughts. But before we jump into that, tell us a little bit about yourselves, how you got into NFTs, CPA and all that good stuff.
All right. Hey, everybody. My name is Peter Kwan. I am a licensed Virginia CPA, certified public accountant with around 8 years of public accounting and tax experience.
Perfect. What about you, Rich? Yep.
Okay. Sorry, I'm used to us like rambling on in our
Yeah.
consult calls, so
Yeah.
I was kind of waiting for him to keep going. No, it's all good. Yeah, Richard Muterspaw, also a licensed Virginia CPA, and unfortunately, I'm the old man of the group, so I have this will be 15 years of tax experience for me, all in public and mostly individual small business taxes. So.
Yep.
Love
And
that. Love that.
I guess before we continue on with this presentation, I did kind of want to lead off with a disclaimer. We are licensed Virginia certified public accountants. However, the contents of this presentation are for informational purposes only and do not constitute an accountant and client relationship. Any tax-related information provided within is not intended to be used to avoid paying any federal, state, or local taxes. Although we have made reasonable efforts to furnish accurate information, we do not make any warranties about the completeness, reliability, and accuracy of this information. Any action you take based upon the information on this presentation is strictly at your own risk. Be sure to consult your tax professional.
Love that. And as always, yeah, do your own research, and again, we're glad to have you guys today. CPAs and NFTs. Can you tell us a little bit about the NFT side of things first? How did you guys get into NFTs? I'm sure the, audience wants to hear, if you guys trade or anything like that as well.
Yeah, so I actually got into buying and selling of NFTs first through NBA Top Shot. And then my actual first purchase on OpenSea was the Bored Ape Yacht Club in the first week of May. I had a couple Bored Apes, kind of staggering all the way up until now. I am down to my last one that I am kind of holding on to dear life until probably early 2022, in which I can sell it and essentially defer my tax income until that return.
Love it. What about you, Rich? How did you get into NFTs, man?
I got into NFTs because of that guy next to me in the chat, Peter.
I think your mic's off, Rich, if you're trying to talk.
Okay, let's see. Can you hear me a little bit better now?
I can actually hear you, Rich.
Oh, you can?
Yeah, I can hear him fine.
Oh, yeah. I can't hear him. Oops, I can't hear him. Let me see.
Do you have him maybe muted?
Oh, I can hear him now. There you go. Got you. Sorry, guys. Technical difficulties.
Rugged by Discord again and again. Oh, if Rich is talking now, I can't hear him.
I can hear you, though.
I can hear you now, too, Rich.
What? That is so bizarre.
We're getting rugged, guys.
Yes.
Yes, I can hear you. Mm-hmm.
crazy, not like Peter's done over these few months or anything like that. So he's definitely the one with a much more practical experience in the space in that respect.
Yeah, and that's always good to know because, I've talked to a couple CPAs and I've asked them about NFTs in the last couple of weeks or so before, I had to talk with you guys. And, a lot of them, they don't know, or they're just assuming they don't understand the whole trading aspect of things. So it's awesome that you guys have that POV as far as, what goes on with gas and, you know, trading back and forth, different wallets, and all that stuff that can really get lost if you're not paying attention to that. So, I kind of want to lead off the questions with, I want to hear from you guys, kind of when it comes to NFTs and taxes, what do traders need to know? Like, what are the fundamentals that we should know as far as taxes and NFTs?
Yeah, so I think it's pretty important for traders to know that cryptocurrency for tax purposes is treated as property. And buying crypto itself isn't a taxable event. It's when you essentially sell that cryptocurrency in which a taxable event is triggered, which unfortunately for us is when we purchase an NFT, which is also the process of selling our underlying cryptocurrency. There's another taxable event when we go to ultimately sell that NFT, but that's just kind of like the underlying fundamentals of crypto and NFT taxation that I think everyone should be aware of.
Yep, and just to piggyback onto that, Peter and I are taking the position that NFTs will be taxed the same as what are classified as collectibles, which would be physical works of art, stamps, coins, trading cards, sports memorabilia, that kind of thing. So in the short term, much like it would be for stocks or any other type of income, it is taxed at your regular ordinary tax rate, which is on the graduated, sliding tax rate scale. And then once you reach a year holding a specific item, the maximum tax rate you would pay on that under NFT structure would be a 28% rate. So if your tax rate is below 28%, you would still pay whatever your rate is. But the maximum you would pay if you hold an NFT for more than a year at the federal level would be a 28% rate. So just that is kind of the distinction we're working with at this time. There is no definitive guidance out there in the NFT space on how certain things are going to be treated. A lot of it from the professional perspective is an inference based on how a lot of other things are treated that are sort of like and similar items. And at some point, the IRS will probably issue guidance down the line that more strictly classifies how things will be handled. But until then, we are kind of operating in more of a gray area and using our professional judgment and expertise and experience to determine what the best course of action is.
So,
yeah.
no, I was just gonna say, I just wanted to follow up on that. Is just like, I take it that everybody at this point is going to have some kind of different style, like different CPAs that you're talking to, especially in different regions and whatnot. Because I'm Canadian, so I have my own other things to deal with. But I'm assuming as long as people are operating in good faith and showing that they're doing their best to pay the appropriate taxes, you're probably on a pretty good track.
Absolutely.
You definitely want to make that good faith effort to report something and pay tax. It sucks. Nobody likes paying taxes. None of us want to do that, right? You guys worked hard to make all these trades and make a profit. You'd like to keep that money, but at the same time, what we want to avoid is anyone getting in a position where they are fighting with the IRS over tax fraud or tax evasion, which is the position of knowingly not reporting and paying any income taxes on this stuff. Regardless of the position you take, you're better off to take a position, file, and pay than to do nothing. There are CPAs that have different stances. We are all not going to agree out of the gate until we get official guidance. You could interview 100 CPAs in virtually any space out there, and when you get into those gray areas, there's not going to be definitive agreement between everyone. That just is what it is. There's stylistic differences. But the important thing is the good faith effort, report something, pay, move forward, be able to sleep at night knowing you've done what you're supposed to do, and not worry about getting into a fight with the IRS over non-reporting and getting into trouble for that.
So, a lot of us here, we started the year off, not knowing what NFTs, I didn't know I was going to be trading NFTs, till May. I didn't keep track of anything. My tax, I haven't tracked anything. Everything's a mess. what do you guys recommend is the best way to get started and kind of structure this year to not be so painful for taxes?
Yeah, so we actually use a combination of software that's available and ready for us to use. Uh, in particular, we've leveraged Zenledger, we've been using Token Tax, and we've been using Coinly. And ultimately, we've had pretty good success running reports through these different softwares. Oftentimes, the cost basis is kind of missing across these reports, especially when there's a transfer from one wallet to another. But in general, the majority of the transactions themselves and relevant associated gas fees are pulled through these different types of software. Um, it's essentially taking the Etherscan CSV report and kind of spitting it out in a more ready to use Excel file, and from there we can kind of manually update the support, the reconciliation, and also uh, drill down into OpenSea and figure out exactly what exactly happened for some of these transactions with the missing cost basis, and to manually update it that way.
Yeah, there's definitely a few items. Peter touched on one. Those that have multiple wallets and they're transferring NFTs between their own wallets, or even if you are execute a transfer in a trade, like you say you swap NFTs with someone else, the systems have a really hard time with those types of transactions because it can't really drill through and track the cost basis appropriately. Um, in addition to that, these programs do struggle with mint cost at times, where you are either minting through contract or you're minting directly through the site, where the NFT originates from. Those transactions sometimes do not pull through via the Etherscan CSV reporting appropriately, so we have to do some manual digging and make adjustments to those. The other kind of things really that we've seen that they're causing issues are token swaps. Whether it's the Uniswap, SushiSwap, right, that kind of thing. It's really difficult for the system to know because all it can tell is that one particular currency token went out and then something else came in, and it doesn't really know what happened in the interim. So there's some manual tracking and digging through Etherscan in particular that has to be done to trace that stuff appropriately. And then if you are doing say staking, DeFi, nodes, that kind of thing, it has a really hard time with that because it just sees something magically appear in your wallet, and it doesn't know if there is a cost basis assigned to that. So there is some manual work that has to be done regardless of the program that we're using. We try and leverage them across each other to fill some of the gaps, and then there's just a lot of manual work we have to do where we kind of have to go digging through Etherscan itself and through OpenSea transaction history to find the appropriate information. So it's a tedious task, but it needs to be done, and there's just none of the programs are there yet. They're all in their infancy. There's a lot of work to be done from a coding perspective on those, and we're hopefully after the first of the year going to start talking to some of those groups to see if we can get some answers from them on how they're going to start shoring some of that stuff up, because they're just not there yet, and it's going to take some time. So we just have to make manual adjustments and do the best we can.
Yeah, those are great points there. Just I would love to hear from you guys. What are some of the implications that could happen if people don't report their taxes this year? 'Cause it seems like, that seems to be consensus in a lot of discords. They're like, if it's not in cash or if it's not US dollar, I'm not going to report it this year because just no one's talking about it or there's no real push towards that. I'm curious to hear from you guys. What are some, things that can happen as a result of that?
Yeah, I would say that if you're knowingly not reporting some of your, NFT related income, in essence, that's just evasion, clear and simple. And you could get into some serious legal trouble and face some serious penalties. Everyone kind of talks about how, MetaMask and OpenSea doesn't have like a KYC, know your customer. But at the end of the day, you're going to have to cash out to your financial institution in some way, shape, or form. And so there's a little bit of risk there when you're essentially transferring funds from MetaMask to ultimately your Coinbase or your Binance account, and then ultimately to your financial institution from there. So we understand that reporting requirements and the reports being generated right now aren't perfect. We understand that, they're not accurate sometimes, but, we do urge people to, at the end of the day, in good faith, uh, try to make a best attempt at reporting their taxable 2021 NFT related income.
Yep, and on top of that, under normal circumstances, the IRS has effectively a 3-year window to put an individual taxpayer under audit or a business, right? So they can essentially go back 3 years and audit any of your tax-related activity in that time period. That's under normal circumstances, right? Once that 3-year window eclipses, they really can't touch anything unless they can prove that you have committed tax fraud or tax evasion. So the big issue that you run into is, yeah, those people might not report anything for 2021, and maybe the IRS doesn't catch it for a few years. But once they really get things up and running and start digging into this market and are able to trace a lot of this activity. And we'll kind of touch on the bills that have gone through the president's office and Congress lately and how that's going to impact the space moving forward. But if the IRS can prove that you have knowingly not reported something, especially if you've commented that in somewhere like a Discord server or on Twitter, something like that in a public space, they can go back into perpetuity. So they can go back as far as they want. So in 2030, if they can prove that, they can actually come all the way back to 2021, and they can put this year under a tax audit against you. And they can effectively make you pay all that back tax, penalty, and interest. And if they want to get really nasty about it, they can send you off to prison for that too. So the risk just really isn't worth it for the amount of tax you're going to pay, even if it's a lot. It's still not worth it to go that route. You're better off making some kind of effort in reporting something, right?
So I'm hearing a couple of things here. One, me being a terrible NFT trader, I feel pretty good about the fact that I don't know if I've actually made any money, and now I'm starting to breathe easy. But no, one of the things you kind of mentioned was just that, like, you kind of said, like, once they really get up and running, I would imagine that in some way, shape, or form, the government is licking their chops at the fact that the blockchain is all public ledger. And that their level of sophistication in dealing with such is going to be very good, especially when they understand how much taxes that they can start to track down with, the snap of a finger. Not to like be devious about it, but how far along do you think they are with that? And like, what do you know is coming in the pipelines?
We don't know how far along they are because there's virtually nothing out there information-wise to know that.
I guess they're not going to tell you.
They're very ironclad on that kind of thing. Yeah, there's no way in hell we're ever going to find that out until they're up and running.
Fair enough.
What we do know is that the Build Back Better plan that the president signed and pushed into Congress, which right now is in extreme danger of not getting passed due to some issues in Congress. But part of that plan, and I would imagine any amendments and changes that would get it passed will include it. The president has requested about $80 billion in funding that would be funneled into the IRS over the next roughly decade. The significant amount of that funding will go into hiring of new IRS agents so that they can expand their audit program. The IRS used to have a really, really robust staff, and they used to have a very large audit department to audit taxpayers and businesses. That has been cut down significantly since about 2011. When the Affordable Care Act first went through, the IRS was at basically their peak employment that they'd had in quite a long time. But once that started to get stripped away and some of the tax implications were kind of removed from that, congressional budgets just started to take a machete to the IRS. In effect, the IRS started to lose a significant amount of staff members. One of the first things to go was their audit department. So they're very thin right now there, and they have a significant backlog. And that's really across the entire agency, but particularly in their audit department. In the last couple years, the statistics have kind of started to bear out that you are as likely to get audited if you make under $50K a year as you are if you make over $500,000 a year, which seems absolutely nuts. But that's just kind of how messed up the system has been lately. But the intent now is that the IRS and the federal government are looking for revenue. right? I mean, we've been spending money at an insane rate lately, so they have to come up with revenue somewhere. The easiest way to do that is to beef up their audit department and really go after folks and start bringing in audit revenue. The top several percent are audited at an extremely low rate now comparative to historical standards, and there's a lot of money out there that the IRS is projecting they can pull in tax revenue. So there could be some major changes coming just from a staffing perspective to really beef up audits in the future tax years. Beyond that, the recent legislation changes. The intent is to apply wash sale rules to cryptocurrency. There's nothing yet designating NFTs under that rule, but cryptocurrencies themselves. The IRS Congress in their recent, legislation prior to the Build Back Better plan that went through in the infrastructure bill, is that they are making a requirement for a lot of these exchanges, which would fall like, say, MetaMask, Coinbase, likely OpenSea, mostly the major exchanges that people are using to trade NFTs and cryptocurrencies on at this point. None of them currently have a reporting requirement for tax purposes, right? Robinhood is about the only major institution that does cryptocurrency trading that has any kind of reporting standards. The intent is to change that starting with tax year 2023, where all of those exchanges would be required to start issuing tax forms on a yearly basis. So MetaMask, for example, would have to get everyone's personal identifying information, social security number, name, address, everything like that resides in the United States and trades on MetaMask. And they would have to actually issue you what they call a 1099-B report at the end of the year, and it would show all of your activity that funnels through your MetaMask wallet, right? So the intent is basically 2 years from now, for tax purposes, for the IRS to make this a completely transparent process where everyone's going to be forced to start reporting all of this stuff because they are going to implement tax law changes that require you to do so. And it's going to be forced from the exchange level, not the individual level, which means we don't have a choice in that case unless we flat out don't use those exchanges anymore, right? So that's a big issue that's coming down the pike. We don't know how feasible that is. That's a tall order for those exchanges to be able to get that up and running in the next 13 months. That is massive. That's such a big undertaking for them. I don't know if that timeline's actually going to hold, but you can bet that the federal government is going to do their damnedest to keep it as close to that timeline as they can. So we may not have much of a choice in the next couple of years, but even if we do, they're going to get there at some point, right? It may be delayed from that, but they will get there. They're slow. They're not stupid. And they're going to come after this money because there's just way too much here for them to be getting tax revenue off of.
Yeah, and with everything kind of being on the blockchain, there's a level of transparency kind of within the NFT space. So if you think that the IRS doesn't know what a Bored Ape or a CryptoPunk is, you're mistaken from a revenue generating perspective. And so definitely keep that in mind as you kind of prepare your 2021 return, and just know that everything is kind of out there on the blockchain to review and kind of look at.
Do they know what a crypto dick butt is? So that's the question.
I don't know, but I wish I could get someone on the phone and ask them that question.
I just call the IRS
man.
and ask, do I have to report taxes on my crypto dick butt?
Yeah. Yep, exactly.
All these things, guys, they sound scary when we think of them. What are some things that we can do now to prepare for, worst case scenario if this does happen, 2023, 2024?
I would say just try to keep accurate accounting records. Maybe talk with the CPA, kind of like myself and Rich, that understand the NFT space and also cryptocurrency space, and just get ahead of the game in terms of planning to report some of this income on your 2021 return.
Yeah,
Yeah,
I think
facts.
that's I think that's Yeah, I think that's huge, right? And I think that, if you can keep your own manual records, and I realize when we're talking to high volume traders, that's such a big ask for them. But for the rest of us, it's feasible and it's reasonable to keep your own manual record comparative to just relying on, say, Etherscan to do it for you. But even if you're going to do that, at least doing, say, a quarterly review of your activity throughout the year, just to kind of see where you are, right, and get an idea of what those profits are looking like, so that you can position yourself well when you get to year end, and there's not this massive, frantic push in the last 2 weeks to try and tax loss harvest when you can be doing that sort of as the year progresses or in the last couple months rather than the last couple of weeks. And it just gives you an idea of like what you're tracking and where you are for the year, so you can start planning and setting aside, whether it's ETH, some other kind of currency you're going to leverage to pay your tax bills, or going ahead and transferring out to fiat and keeping it in some other platform that's going to allow you to be ready for that when tax time comes around. Because the last minute scramble and being retroactive, it makes it so much harder rather than being proactive and being on the planning side of it ahead of time and as time commences. Waiting till the last minute just makes it so much harder to do anything tangible to make a big difference. And then if you're doing it throughout the entire calendar year.
Yeah, those are great points. And as the year comes to a close, we've seen some traders who have amazing gains this year. What are some things that these traders can do to lessen the tax burden for 2021?
Yeah, so from a tax perspective, you want to ideally accelerate deductions and to defer income. So if you're sitting on any NFTs that have unfortunately gone down in value, it might be most prudent to realize some of that loss. And essentially, if you wanted to hold it long term, you can even buy it back. Um, you can there's no time window on how quickly or how delayed you buy back this NFT that you realize loss on. You can do so immediately, as wash sale rules do not apply to the NFT and crypto space for the tax year 2021. This may change going forward into January 2022, but the way that it's written right now, the law, um, you are good to essentially realize a loss and buy back crypto or an NFT at the moment. Oh, and you can also even bundle some of your worthless NFTs together and essentially sell it at 0.00001 ETH to realize that loss, and essentially get this worthless NFT out of your wallet. If your NFT is essentially just dead and no one wants to take it for pennies even, you can go ahead and burn that moment, and that just kind of means transferring that NFT into an inaccessible wallet. Rich and I actually created a burn address. It's just worthless NFTs.eth. And basically, if you're sitting on a hidden folder full of crap that you can't sell even if you wanted to, you could essentially transfer those moments over and write off any gas fees associated with it and also the initial cost of the purchase.
And you pinky promise that
Interesting.
this isn't your own wallet, that you're just sitting on like tens of thousands of NFTs with ultimate upside on it?
Yeah, it's all on the blockchain. If the worthless NFT that you kind of transfer over does come back to life, I promise to essentially transfer it right back to you.
Oh, wow.
Oh, really? I didn't know that. That's cool.
Yeah.
That's pretty dope, actually.
So here at AlphaMint, we were gonna do like a little bit of swapping, like me and Scott. So we created a bundle. He was gonna buy my bundle. I was gonna buy his bundle. Would that kind of work the same way, or is there cons and pros to each of those methods?
Oh, that would absolutely work. The biggest con that I can think of is if Scott essentially buys your bundle and ultimately wants to keep it and never wants to sell it back to you. In essence, you're kind of shit out of luck there, right? So there is a little bit of a risk in kind of who you're transacting with, but from a realizing a loss from a tax perspective, you are good to go.
What about gifting it to somebody, or like a family or a friend? I know that's a big thing, and I see that in the questions here. Would that work as a write-off?
Gifting does not work. Okay, so there are a couple of things to touch on with that. Is that when you gift an NFT, that does not constitute a tax write-off for you unless you are gifting it to a qualified charity, which would be like a 501c classified charity, right? A personal gift to a friend or anything like that does not count. Now, if you are, say, running an NFT project, and you are, gifting NFTs as part of a promotional program to, get more exposure for your own project and things like that. That's a different story. That's more of a business write-off type of question that we could tackle, separately. But on a personal level, gifting an NFT, whether even if it's somebody that you're not related to, does not constitute a tax write-off for you. And technically, if the value of the NFT is over $15,000, you really technically should be filing a gift tax return for the value of that NFT, the dollar equivalent value of it, based on what you paid for it, if it was over that amount. Then, now, related party is another thing. I'm glad you brought that up, Maz, is that you cannot sell NFTs to a related party for a loss and take it as a tax write-off. So that would be parents, spouses, siblings, your kids, anything like that. Those related people to you, right? Friends do not constitute a related party, but those of your relation, you cannot sell to them at a loss and take that as a tax write-off.
That's okay. That's good to know because I was gonna have one of my friends buy my 888 that I bought it for 3 ETH. I was gonna sell it to them for like 0.05 and just let them keep it. But that's good to know. Then I probably won't do that. So what's the best way then to just do that? To just do it maybe through like trusted sources, but not family related. Then essentially, correct?
Yep, exactly.
So one of the
Okay,
questions
perfect.
that, oh yeah, sorry, Maz. One of the questions we get asked a lot is, and I think it's the big one on everyone's mind, is how is gas supposed to be
Yes, that's what I was
treated?
gonna ask.
Oh, perfect. On the same page.
Perfect. Mhm.
Yeah, so when you're minting, sometimes you get into these gas wars and the price of gas can be ridiculous. There was actually a website floating around. God, the name of it's escaping me. Maz, do you remember it? That showed the amount of gas your address has paid?
I don't, but I remember Pranksy's tweet where he spent $1 million plus in gas fees this year. So how would that work for
Yeah,
tax
because I
purposes?
was even shocked at the amount that I ended up paying in gas, like to the point where like it's almost crazy that some people can be like really really profitable. But like, is that something you could just show them a screenshot of that page and you're good, or you gotta collect all of the data? And how is it treated? Is it an expense or is it built into the cost basis of the NFT you purchased or minted?
Yeah, so I think the website that you're alluding to is called fees.wtf. And
Yes.
essentially, you can kind of punch your wallet address in there, and it'll tell you how much in ETH in gas you've kind of spent on the year on NFTs. Now, be careful because it kind of calculates. It takes the ETH spent. It takes the spot price of ETH at the current prices right now, and it multiplies it out to get the total fiat value. Um, Now, that doesn't necessarily mean that when you went to transact with some of these NFTs, that was the spot price of ETH at this time, so it's not completely accurate. Um, in terms of gas, you're absolutely right, R2. When you uh, when you incur transaction fees like gas, what you want to do is you want to add that to the essentially add that to the cost basis of the NFT that you purchased. And so ultimately, when you go to sell this NFT, it's going to lead to a reduced taxable income because gas would have been included in the cost basis of this purchase.
And then
Kiwi brought up a great question. Sorry, didn't mean to cut you guys off. As far as, what about failed transactions for gas? Is that something that's also included? Because I know we spend a lot of money on transactions that don't necessarily go through.
Yeah, so ultimately, if you're kind of incurring gas fees that aren't captured in the NFT as a whole, we personally think that it is ultimately going to be a deductible expense from the rest of your 2021 NFT related income. But there are other CPAs that do not agree. But yeah, we would consider it kind of necessary and ordinary, and a cost of essentially doing business. And if it weren't already captured on the NFT reconciliation / support that we are kind of pulling from Etherscan, we would find some way to deduct for it.
Amazing.
Yeah, the idea would be to do like an aggregation of summarizing data into, I mean, the whole idea for this is when we're doing reporting, we obviously want to report any individual larger transactions individually, right? Because those stick out in a review of an Etherscan. If you've got a transaction for 5 or 10 ETH individually, obviously that's a lot of money when we're talking fiat. So those stick out pretty substantially. Beyond that, we're kind of looking at doing like an aggregation aspect where we're just going to lump NFTs into groupings and sort of summarize that data, because we have all the underlying support in our and the client's records to verify that if we should ever need to provide that support to the IRS. But for condensing the data's sake and making the reporting a little bit easier on everyone, we're going to kind of aggregate that stuff together into groupings. And the idea would be that those kind of gas fees we're going to add into the overall cost basis of what we report, so that we're making sure that we capture those on the year. As Peter mentioned, that is a bit of an aggressive stance. That's probably the most aggressive stance that we take, but we do have reasons and justifications for why we're doing that. There are other CPAs that disagree with that, and that's fine. Some CPAs don't believe in taking any gas fees at all. I think that's completely asinine personally, and I just don't agree with that. So it's aggressive, yes, but it's an aggressive stance that we feel very comfortable taking and have an argument to back up for why we're doing it. One thing I wanted to point out, I don't know if you guys saw the Medium article or looked into it, but Etherscan is actually added in. If you go into your wallet address and you go to, or any wallet address, and you go down to analytics in your Etherscan, there's a new tab called transaction fees that they've recently added. And it actually shows you total fees spent as a sender and total fees used as a recipient year to date in your Etherscan wallet, and you can actually set the date time frame that you're reviewing for that. I was working with a client earlier today, and we're trying to verify how accurate that number is comparative to other sources. But the number was pretty good. I don't know if it was 100% accurate, but it was pretty spot on. The problem we're running into with any of these third-party sites you're seeing, like the infamous screenshot from Pranksy now, is that,
Yeah.
like Peter said, those are pulling in like spot pricing as of that date. So the day Pranksy pulled that, ETH was trading at 4,200 on that day or something like that, right? So I mean, yeah, he's probably still spent well over $1 million in gas fees for the year, but it really may only be $1.25 million, not 1.9 million or something like that. I mean, that's still an insanely bullshit, stupid amount of gas fees. But it's not completely accurate because it's pulling spot price as of the moment that he went on the site and it pulled his wallet, as opposed to the actual historical cost at the time of each individual transaction, right? But the idea behind this analytics on Etherscan is that it's supposed to be pulling the spot price from the time your transaction occurred, so that in theory should be a much more accurate number of what we're actually looking for and would be able to utilize in terms of tax reporting for the year.
I'm looking at mine right now, guys, and I did not want to see this number. I'm in pain right now. Damn. But it shows you, this is actually good. It shows you the adjusted price and what it would be with the current price. So that's actually pretty cool as far as, showing you the price of ETH during those times, and it breaks it down for you. So that's really cool. I did not know that. So definitely, if you guys are listening, check that out. That's awesome.
Yeah, this ties really well in.
Brand
sorry,
new.
Rich.
No, I was gonna say that's brand new. They just released that in the last week, because I've been digging around furiously through different sites trying to find an accurate number places, and I just could not find shit. And they came out with that, and if I knew where to go, I'd go somewhere and kiss somebody for coming out with that, because that's gonna make it so much easier moving forward.
This ties great into a question that Fry had in the chat, and he said your profit is in ETH, but taxes in fiat. Exchange rates changes constantly. How do you deal with that? Is it the date of the sale? And I think that I understand that the answer is going to be that you do have to take the value of ETH and how much it was at the time. But can you elaborate on that a little bit more, or even just how to keep track of that to the best of your ability?
Yeah, that is the kicker in the NFT market. Is we kind of have a multi-pronged tax transaction every time we do anything, right? So when you acquire your ETH in the first place to go buy an NFT, whatever spot price of the ETH was the day you or the minute you purchased it, right? That is your cost basis in that ETH. Then when you liquidate it to buy an NFT, ETH has likely changed. Even if it's only been a few minutes, it may have changed just a couple pennies. If you've held that ETH for months, or we even have traders who have been holding ETH since like 2013 that they transferred into their wallet and purchased NFTs with, you could have significant changes in your cost basis of ETH from the time you acquire it to the time you liquidate it. And so that is kind of the kicker. Is not only are we having an ETH transaction on the front end, buying an NFT, selling an NFT, creating a second tax transaction. Now you've got a new ETH price from the time when you actually sold your NFT and acquired that ETH. Then you've either got to turn around and buy another NFT with that ETH, or you're actually transferring it to US dollars to then pay your tax bill later. So it just kind of like stacks on top of itself over and over again every time you make a transaction, right? And it causes more tax transactions every time you literally do anything. So that is where that cost basis comes from. It is based on the time you acquire that item, whether it's the ETH, whether it's the NFT, it doesn't really matter. When you transfer one currency to another, it works very much the same way. That is where your cost basis for that ETH comes from. It's really, really hard to track that. That's why leveraging these tax programs is so key, because it's able to pull that through Etherscan, because it knows the amount that you received at spot price at the time you sold your NFT and acquired that ETH. And it's able to track that cost basis for us. And there are some different reports that it runs that we kind of leverage to track cost basis and come to those numbers. There are a couple of different methodologies you can use to determine which cost basis to associate with your cryptocurrency itself. So there's some legwork to be done there. The software does a pretty good job with that component of it. We do still have to do some manual work on that, but for the most part, those tax programs are pretty accurate with that part of things.
So am I?
Yeah, that's awesome.
Oh, I was just gonna say. So if I'm understanding this correctly, if I buy an NFT for 1 ETH and the price of ETH is $4,000, and then I sell that NFT for 1 ETH, so I've broken even in ETH, but the price of ETH is now $3,500. I've actually incurred a $500 loss.
Exactly. Plus your gas fees. Yes.
Yes,
that's
of
correct.
course. Yeah. Just okay. So that's interesting. Does this do you know if this plays into people's trading strategies as well?
Well, it does for year-end tax planning, right? Because we've had this discussion quite a bit with clients that, maybe they had one NFT that sold for, 50 or 100, or, in one case, like, 200 and some ETH, right? So when you've got a large transaction like that and you're acquiring a massive chunk of ETH at one spot price, then what comes into play is tax planning opportunity. If you are looking to generate losses in that case in order to be able to pay your tax bill, you would want to liquidate that ETH when it's gone down, right? Because that way you're actually creating a tax loss by timing your transactions appropriately. So let's say you had a 50 ETH sale and ETH was trading at $4,000 at the time that happened, right? So that's your cost basis in it. Well, then maybe you want to transfer some of that out to cash, or maybe you want to just keep buying and flipping other NFTs. If you then wait and you make those next set of transactions when ETH has dropped to say 3,600, you've actually just generated tax loss by literally doing nothing but sitting and waiting. So there is a tax planning strategy and opportunity with that. It's just, if you're doing a lot of high volume trading and you're flipping quickly, it's not as something to be as concerned about, because you're doing it so much so quickly. The spot price of ETH is not changing. holding things for long, and then you're making transactions. That's where that strategy really comes into play, and you have to pay attention to that closely.
Amazing.
Is there a benefit to holding an NFT for over a year before selling?
Yes, you get that long-term collectible tax rate, which is a maximum of 28% at the federal level. So if you bought something in May of 2021, you hold until 366 days, and you sell it in May of 2022. Even if you sell it for $400,000, right? Maybe you've got an ape you're just sitting on, and you're going to sell it for 400 grand. You're not going to pay that top tax rate of 37%. The max you're going to pay on that is 28% at the federal level. That's 9% difference on $400,000 of gain. Dude, that's a lot of tax. That's $36,000 in taxes you can save, right? So it makes a huge difference when you do that. It's just a monumental difference in taxes. And when you stack that up over a lot of transactions on blue chips that you're holding, it really goes a long way in tax savings.
Love that. Right now, the only things that I've been holding have been going down in value. So hopefully we get to that level where in a year, they're up in value.
Yeah. That would be great.
How long have you been doing specifically crypto taxes?
February of 2021. No,
Okay.
I've had a couple of guys trading. I've had a couple of clients just trading cryptocurrency for probably 3 or 4 years now. Not a significant amount of individual traders, but cryptocurrency itself is very straightforward from tax purposes. The NFT stuff is that's the whole different ball game now, because there really is nothing written on that. Cryptocurrencies, they started to get a little bit of tax code written about them in around 2009. And then 2013, 2014 is when the IRS really made a more concerted effort to start writing actual tax law tied into how cryptocurrencies would be treated, and kind of like the analogous way that they were going to do that. And that's when we kind of had that a little bit of popularity there, and then things kind of died off for a while, and they didn't really get popular again, until 3 or 4 years ago, quite as in high volume as they got. And then 2020, late 2020 into 2021 is where things really have just taken off across the board. And a lot of that is the NFT market, right? I'm not sure that there are hardly any CPAs that have been dealing with NFTs beyond 2021, because there was hardly anything there before this year.
Yeah, for sure. The reason I specifically ask is because I think it was also very poor timing. But in the 2017, 2018 bull market, people saw some incredible gains. And then right around the turn of the year, things took a real big nosedive for the worst. And then, people all of a sudden saw their assets drop 90, 95%, and they couldn't even sell enough crypto. They didn't even have enough crypto left to pay the taxes that they had incurred the year before. And I suppose that there's a scenario that I could see that happening with NFTs and Ethereum, because their cost basis is in Ethereum or whatever chain they're on. How do you protect yourself against something like that?
Yeah, that's a big problem, and we are seeing that, is that when you've got a lot of high volume trading activity, you may have significant profits, but you don't have much liquidity sitting there, right? Because it's tied up. It's tied up in your projects that you're holding and flipping. So there's just not much liquidity, even in ETH or whatever cryptocurrency you're using to trade on, whatever chain it is. Most of that money is tied up into the actual NFTs themselves. So there's just not much liquidity sitting there. So we might talk to traders that have well into 6 figures or even 7 figures of gains, but they don't have much liquidity sitting around, because the vast majority of that money is tied up into projects. It's kind of the same thing if you got a big $1 million stock option, and then you bought $1 million house, but you still have to pay taxes on the $1 million stock option you got. Well, that's great, but you don't have any cash sitting there to pay your damn tax bill now. It's kind of the same concept, just like it was with crypto back in the 17, 18 time period, So the big thing that we kind of talk about is, the first thing you can do moving forward, obviously learning the lesson now, is that every time you start making trades, particularly when you're getting into healthy profit trades, is to essentially carve out a component of that profit that you're receiving and just set it aside in ETH, even if you don't convert it to fiat. At least keep it in ETH, transfer it out of your MetaMask so you can't really touch it directly. Put it into whether it's KuCoin, Coinbase, Binance. It doesn't really matter. Get it off that exchange where you can't touch it, and kind of keep it as an out of sight, out of mind, at least temporarily. And just have that as a plan for tax purposes, right? And if you're a high volume, short-term trader and you're anticipating making, pretty substantial gains throughout the year, you probably want to take, 35 to 40% of those profits and just set them aside. And I know that makes you want to puke when you hear me say that, but that's a realistic number if you're talking about a lot of trading and you're making a lot of profit, right? And then, the other thing that we're working on now is we've just gotten so late in the year with a lot of people and this being so new that we don't really have that luxury right now. So the best thing to do, and Peter touched on it earlier, is, when you get into this time of the year, you don't want to be selling a lot of things at a high profit before the end of the year in this last couple of weeks. You want to be holding those off into 2022. So if you have anything that you are sitting on a very large appreciation from when you bought it to what you could sell it for now at market value, and you want to sell those items to be able to pay your tax bill and get some liquidity, you want to hold off on doing that until at least January the 1st. Because if you can do that, that actually pushes that tax transaction into next tax year. And that gives us an entire year to tax plan for that occurrence going on. But it gives you the liquidity before you pay your tax bill for this year. Your tax returns due April 15th, unless they change the deadline again. So you don't have to pay your tax bill until the date of April 15th. You have the next 3.5 months to plan for that, get everything lined up, get your liquidity ready to pay that bill if you're going to pay it on time and to pay it in full. So that gives you a big planning opportunity in the first 3 months of the year to kind of space out that activity, sell things where you're going to sell at a profit, push that into next year for a taxable event, but be able to have the liquidity in time to pay your tax bill for the 2021 tax year.
Yeah, and to piggyback off the general strategy, what we can also do, one, plan to move to more tax-friendly states, of course, selling any of our NFTs that are at a tax slash. So that's one perfect legal tax strategy for your tax liability.
Hey, sorry, Peter. I don't know if you can hear me, but your mic is pretty off. Something it's very, very hard to make out what you're saying.
Yeah, he's got really bad service up there in the mountains. Part of what he was touching on is one thing we've discussed with some of our traders that are sitting on big blue chips, or if they're just planning on being high volume traders moving forward and expecting to make, well into 6 figures of profit on a yearly basis, is moving to more tax-friendly states, right? We've got a lot of clients in California in particular. California is a beautiful state. People love living there. The tax rates suck. The top tax rate is almost 13% at the state level. So not only are you getting hit with a 37% top federal rate, plus what they call the net investment income tax, which is another 3.8% on top of that, but you're also getting hit with a peak rate of like 12.9% at the state rate in California. So states like California and New York in particular, the tax rates are just brutal for you when you're doing trading there. And it's just, if there's reasons you're going to stay there, fine, but just understand that in doing that, it's a lot of extra money that it's costing you just simply by where you're living geographically. If you move to a state, say like Texas, that has no state income tax, you're saving a substantial amount of money. If you think 12.9% peak rate in California, and you make $1 million in a year, Jesus, that's so much fucking money right there, right? And if you literally, if all you did was move to say Texas, the amount of money you would save just by that move alone is astronomical on a yearly basis. So we've had that discussion. We've had a few traders already move. If you move before you sell, say, a punk or an ape, if you've got a collection of cool cats that you're going to liquidate next year, and it's going to be a lot of gain, move to another damn state before you do that has much lower tax rates, please, because that's just going to save you a lot of money. One other thing, we do have a few traders that are actually going to get married before year end. They've got long-term significant others. They've been thinking about getting married anyways. And if you legally get married before the end of the year, married filing joint tax rates are more favorable than for single filers. So we're not in the market of giving marriage advice necessarily, but if that's an option on the table for you, it's probably something to consider next year, if not this year, because you do get a little bit more favorable tax position by filing jointly, depending on the income scenario for everyone involved, as opposed to as a single filer. So those are a couple of extra things we've talked about with some of our traders, and I think those are the things Peter was touching on, but his connection is not great where he's at right now.
I think we probably
Yeah,
just saw a large influx of couples flights to Vegas right now.
Yeah, yeah. You might, yeah, those airlines are going to be very excited to see their bottom line for the next 7 days. Peter, are you there? Yeah, he's struggling with connection this week, unfortunately.
It's all good. He's in there in the tax questions chat answering away. I saw that too, which is amazing. Definitely can still see
Yeah,
you.
we've done this before. Yeah, we've done this before. We're kind of tag teaming it that way. So, yeah.
No, that's great.
So, all right. Okay.
Maz, do you have any other questions? I wonder if we actually lost Maz. I can't hear Maz.
I can't hear him either.
I actually just have one question for you
So,
while Maz gets it settled.
sure.
What is the one thing that you would say to any clients or prospective clients, or the one, sorry, I should say, the one thing you wish you could say to them when they come to you with this stuff? Like, what's the biggest frustration point that either in preparedness or just attitude, mentality, like, you can't say it directly to anybody, but maybe you could just say it in like a broad stroke. Like, what's the one biggest pet peeve you have in dealing with this stuff?
I don't know that I'd call it pet peeves particularly, but I think a couple of things that we see are no idea what they've got at all. They're just not tracking anything. And I mean, again, it's, the Etherscan reporting and all of that is great. It allows us to leverage technology to pull a lot of this information and get everything adjusted correctly, but that doesn't mean it's perfect. I mean, as far as we know, it's very accurate and captures everything correctly. But what if it doesn't? And there's opportunity missing because there's just nobody really truly tracking that at their individual level. We've got traders that are doing that and kind of know where they are throughout the year. It's not that it's a big pet peeve. It's that biggest opportunity for moving forward is being on top of your own shit and knowing where you are and knowing where you stand, right? And in particular, if you're someone who's into DeFi stuff, whether it is, getting into nodes, you're getting into staking or play to earn gaming and things like that. It's really big to try and track some way and keep record of what you're doing, because some of those exchanges and things you're using, they don't have hardly any reporting at all or any kind of reports that we can leverage whatsoever. We can mine through Etherscan and find some components of it, but there's a lot that we just can't find. And that makes it really, really hard to track that stuff. So in order to get appropriate, reporting, it takes some legwork on your individual level to stay on top of that. If you're someone who has a handful of different wallets, you like to buy in different ones and trade them back and forth between wallets, just know that's going to create a lot of extra work either for you or for your tax accountant in order to determine where your cost basis came from and what that amount is, because it just adds extra layers to the equation, and the programs don't do a good job of piecing those things together because it doesn't really know that you own all of those different wallets. Those are kind of the big things with that. One thing I did kind of want to touch on, and I don't know if this was something you guys were going to bring up or not, was the whole concept of either filing and reporting everything just as trading income, like you would for stocks or cryptocurrencies on, say, Schedule D, as opposed to doing it on Schedule C and actually considering it a business, like a business venture instead.
Is that you're getting
So
into
I kinda wanted-
LLCs now?
Yes.
Yeah. Okay. Perfect. Peter was
Perfect.
asking me to highlight that as well.
Yeah. Yep. So, I want to dig into that a little bit and kind of go over the differences in what the tax would look like, and we can sort of dig into this here. So, um, the most straightforward way to do your reporting is to do it on Schedule D as essentially trading activity, right? And that would be no different than you if, say, you were a day trader on the stock market. The taxation's different, but the methodology would be the same. So in that instance, we just report everything as we're going to do with the vast majority of our traders. When you're doing short-term trading, it doesn't make a significant difference to report it that way because you're paying your regular tax rate no matter what. When you get to a year or more, it does make a difference because when you get to that year or more, that's where that 28% maximum federal rate comes into play if we file it as trading income on your Schedule D. Okay. The alternative method is to say, do a one-man LLC or just a sole proprietorship, file on your Schedule C. That opens up some opportunity where your trading income is treated as ordinary rate income, and that is no matter how long you hold it. So that is one downside, is even if you have an ape and you hold it more than a year, if you classify your trading as a business activity and you report it on, say, a Schedule C, like through an LLC, you lose that 28% long-term rate. Now, for a lot of people, that may not be a big deal because they're short-term traders anyways, so that doesn't make a big distinction for them. But if you're someone who's got blue chips and you plan to hold them for a while, that could make a big difference when we're talking about that 9% tax difference at the federal level, right? So that kind of partly plays into the equation with that. It does allow you the opportunity to take write-offs. So there's obviously, the cost of your NFTs that you're selling, which you get no matter what. But then in this case, it would be things for, say, you buy a new laptop and you're using it. You buy, headphones, you buy, AirPods, you buy new computer monitors, office furniture. You can take a write-off for a component of your home internet costs. If you've got subscription services, or say you've bought, a token in order to access a private Discord or server system kind of thing, those are expenses you can write off. Accounting fees for tax preparation, legal fees, anything like that. Those expenses can reduce your overall profitability from your NFT trading activity if you treat it as a business. Filing it as just like trading activity on Schedule D, you don't get access to all of those expenses, right? It's pretty much just what you sold your NFT for, less gas costs and the acquisition cost of the NFT. That's all that comes into the equation. It's much more straightforward and simplistic. The opportunities there are that let's say that this trading is all you do. You don't have a full-time day job, or maybe you have one, but they don't offer you health insurance, and you get your health insurance through either a private plan or like the health insurance, the exchange at the state or federal level. You can write your health insurance premiums off against that income. That is one nice tax deduction perk that you can get. You can talk to your tax preparer or CPA about setting up what they call like a SEP IRA plan that ties into your NFT business activity, where you can actually make a contribution to a retirement plan based on the profitability that you've got. That can become a really nice tax savings vehicle. If you decide to, say, incorporate that entity, you can look at doing what they call like a cash balance retirement plan, which opens up the door for a much more substantial tax savings opportunity. There are a couple of things like that you can utilize. The hard part is finding the right window where treating it as a business activity makes sense. And I say that because when you go the business activity route, you are subject to your regular income tax, just like you are in pretty much every scenario imaginable. But you are subject to what they call employment taxes in addition to those regular income taxes. So if you're like an employee and you're working for someone else and you're on a W-2, right? When you look at that W-2, you've got your gross wages and then deductions for health insurance, retirement plan, that kind of thing. Then you've got, federal income tax withholding that they withhold out of your paycheck. But then you also look and you have Medicare and Social Security taxes in the United States. Those are taxes that are paid into the federal Medicare and Social Security programs that fund those on a national level for, recipients who claim those kind of things. those combined taxes are 7.65% at the employee side of things. So the wages that come out of my paycheck, right, or your paycheck or whoever, it's 7.65% of your wages get paid into those combined funds. Then your employer has the match component. So they pay the same amount in to that federal program, right? So the collective employment taxes that get paid in for you is 15.3% overall of your wages, right? Well, when you run everything through like a Schedule C as a business activity for NFT trading, you are subject to those employment taxes because the IRS then classifies your business as the employee and the employer at the same time. So you have your regular income taxes that you're paying anyway, but then in addition to that, for the first $144,000 of what you earn as a net profit, they're slapping an additional 15.3% taxes on top of that. So you're just compounding your tax problem. If you're in the right window of opportunity and you have enough business deductions to take against it, you can actually end up with a lower tax liability by doing it that way, rather than putting it on a Schedule D. You have to run the numbers, and you really need a professional to run those with you, because that's something that you can figure out when you file your tax return this first year, right? If you're just going to file on a Schedule C, clients that we're working with, we can literally run them the numbers both ways before we file the tax return, figure out what better methodology is, and run with that moving forward. Doing it on your own, you can still do it. It's going to be a lot tougher that way. But if you're working with a professional, you've got a really good opportunity to try and run numbers and figure out which is more beneficial to you and the reasons why you'd want to do it one way or the other. So doing it under that like LLC Schedule C method, there are situations where it makes a lot of sense. If you've got a lot of business write-offs you can take against your income, that is one scenario where that might work. If you really want to look at funding a retirement plan and you're paying for your own health insurance out of pocket anyway and those expenses are fairly high, those are scenarios where it might actually work as well. If you're someone who actually has a full-time day job and you say make $150K a year there and you're trading NFTs in addition to that, you're already paying those employment taxes through your W-2 job, your actual day job, and there's a hard cap on that on a yearly basis. Like you can't pay more Social Security in than the maximum limit, which is like $144K for the year in terms of income that you pay on. So if you actually make enough earning money from a day job, you've already capped out of that Social Security limit anyway. So the vast majority of that additional tax is out the window, which means that there's probably a much better opportunity to come up with enough expenses to offset the rest of it. And in that case, that puts you in a much more ideal scenario to take advantage of this situation. It's just for a lot of traders, it's really hard to get there, especially if this is what they're doing full time and you're making a lot of money. You're just subjecting yourself to so much additional tax that it's really hard to make that the appropriate way to treat things. And if you're someone who's holding stuff long term that you're for large profits later, that's really probably not the ideal scenario to be in. And there is one major misconception I see floating around out there a lot that I want to go ahead and clear up now, is that a lot of people have this idea that if you treat it as a trader business and you file it on a Schedule C, that all of the costs of the NFTs that you've purchased for the year is a tax write-off up front. That is not the case, okay? You can only take a tax write-off for the NFTs that you have actually liquidated out of your wallet and out of your possession. So it doesn't matter that you've purchased $700,000 of NFTs in total for the year. If you're still holding, say, $300K of that in your wallet currently, you don't get to write that off until you actually sell those NFTs. So you can't just take the full $700K as a purchase price and take it as a business expense. You can only take as a business expense what you've actually liquidated out of your wallet. The balance of that is considered inventory, and that sits on your tax return and has to be reported as that figure. And then as you liquidate those into the future, that's where the tax write-off for those items comes into play. So I see that floating around a lot, and people think that's some big workaround to filing as a business activity, but that's actually not the case. That's not how it works. So just clearing that item up, that's kind of one of the big ticket items that people think that makes it more sense to go that route, and it's just not the case.
And that includes, like you said, the gas also can't be written off. It's built into the cost basis of the purchase and only taken off once it's sold as well, right?
Yeah, I mean that's the thing. Like it's those NFTs need to get out of your wallet in order to be able to realize the cost of related to those items, right? And so that's where it becomes really tricky to get that business model to be the way that works best for most people. But someone like a professional can help you run those numbers and determine which way works best for you.
Hey, can you guys hear me?
Yeah, you're good, man.
Yes,
Oh, perfect,
we got you
perfect. I'm
now.
back.
Yeah.
Rich, one other question before we let you guys go. So we've been seeing this happen a lot lately. So what happens when you get, let's say, you get your Bored Ape stolen, or you lose or you get hacked? You know, what do you do as far as taxes there?
Oh man, this is always a fun topic because this unfortunately happens more than it should, and you really hate to see it happen. So,
Curious you drag
um,
Bored Apes into this.
you know, so so, so technically the way that works is that's classified as what they call a casualty loss, um, and there is a very specific avenue to take a tax write-off for that. It's a bit of a convoluted process, and it is totally dependent on your individual tax situation, the dollar amounts involved, and if there's enough there to see a tax benefit for it. So there is a method to get a write-off for that, right? And it's just going to vary scenario by scenario. That's where you really need a tax professional to help you out if something like that's happened to you, to determine the best course of action to try and take a tax benefit for that.
Perfect. Well, guys, you know, we appreciate your time. You know, we understand we're in a hard cut of here. R2, how you feeling about taxes, man, after hearing them talk for the last hour or so?
Oh man, I'm amped. No, honestly, like it's obviously not the most fun topic, but it's probably the most important one to discuss. Whether you're profitable or not, it's an important discussion, and I think a lot of people really are going to take a lot of good things away from this and really kind of rework how they're thinking about trading and what they're doing. So, I mean, I just think it's so valuable. And I think you guys are going to have a lot of a lot of work ahead of you too.
Yeah, we're already there. We're doing a lot of reconciliation and year-end tax planning work right now. We've been completely underwater with that, with a lot of holiday time and some family stuff going on for both we've been dealing with. So, we appreciate you guys having us on. Thank you so much for the opportunity. It's been great. Doing the podcast with Maz was awesome, and getting in here again has been a lot of fun. If anybody in here does have questions or anything, I think Peter's wading through the NFT tax questions chat right now like a champion, so he was working through that. You guys can also shoot us a DM here on Discord, and we'll tackle those as we can and do the best we can to get to all of you as soon as possible. You can find us on Twitter, and we can get in contact with you guys and try and help answer some further questions and specific scenarios and questions on certain things you guys might have, and see if there's ways we can help you out and do anything to see if we can get you going in the right direction. So more than happy to do that for you guys. Just get in touch some form or fashion, and we can take it from there.
Love it. Well, thank you guys so much for coming on. We wish you guys happy holidays, and yeah, we appreciate this.
Yeah, appreciate
you
it.
got it. Happy holidays, guys.
Thanks everybody.
Happy holidays,
Absolutely.
guys.
Yeah, and if you guys happy holidays, and if you guys are listening, we're gonna record this, right? R2, so people can listen later and share it.
Yep, was just gonna say that. This will be fully recorded. We're gonna have it up on YouTube for you guys. We'll rip it into audio so you can listen to it too, because honestly, you're just gonna be staring at my face for most of it. But yeah, you can use this for reference. For your own research as well for the future. So yeah, guys, thank you so much. This was amazing, and I've learned so much today.
Absolutely. Same here, guys. I'm going to definitely rewatch this again. And yeah, let's go harvest some taxes, baby. See you guys in the next one. Peace out.